Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in Landon Swan. He's a co-founder at LikeFolio. Welcome back to the show, Landon.
Thank you, Tom. It's great to be here.
All right, so we're talking used cars. I always compare this to Carvana, and I look at the chart of that. It's up 100% so far this year. Are they taking market share away from KMX, or is this an industry-wide thing? I know it's short open interest on Carvana, but it seems like we've seen some negative returns here for CarMax, and I'm not sure how to pinpoint it.
Yeah, I mean, you compare these two companies, Carvana and CarMax, and just the last 3 or 4 months chart is pretty glaring when it comes to which way they're going. Both of them had big earnings reactions. One, Carvana to the upside, CarMax to the downside. I think the answer is it's kind of industry wide. I mean, we're looking at lower lease volumes, which usually means there's lower supply. So it's more difficult to get used cars as CarMax buying. If you look at 2019 and 20, there was about 6 million leases annually. And in 2021 and 22, there's 3 million. So there's just less cars for them to buy, which means there's less cars for them to sell. They're paying more. It's difficult. Last quarter, they bought 11% less than previous. So it's difficult getting their hands on inventory. And speaking of last quarter, they absolutely got crushed. Their income fell from 69 million to 50 million. They've got a goal of selling 2 million cars annually, and they had to push back that goal from 2026 to 2030. Investors don't like to hear that kind of move. So they've just not been doing great. And so, even when you look at like auto market or AutoNation, the new vehicle revenue is up 2%. The used is down 2%. So CarMax is all about selling those used cars, and it's just weakness across the industry, I think. They do have happy customers, though. I will say that they've got the highest among the three between them, Carvana and AutoNation. They're the highest at 69%. I think people like the no hassle, the return policy, that kind of stuff. Plus, frankly, I think they give good deals when you're selling your car to them as well. They usually do better, I think, higher offers. So people like working with them. But for whatever reason, the data that we've got is just showing them really falling behind when it comes to actually following through and getting these customers. I mean, you look at the web data, they're up about 9% on a year-over-year basis, which sounds good given all the stuff that I've been saying about the industry. But AutoNation and Carvana are crushing them. I mean, they're up much, much better, much higher numbers there. And so, you can see why Carvana's done so much better in the market, in the stock market, than CarMax has. So, right now it's a really beaten up stock. So despite all this, it's hard to be super bearish on them because a lot of the bad news is out. I mean, all that stuff that I just talked about on, the last quarter report and pushing back the goals. Investors all know that now. They know that they know everything that I've been talking about. So that's why the stock is so low. So really it's about what's changing in the future. We don't have any great news on them. We don't have any data that says it's turning around. We know that they're behind. The market knows that they're behind, but the stock's so far sold off, it just got crushed, that it's tough to short them here. I don't think I'd be buying, but it's also a little tough to short at this price as well.
Landon, is there a bigger picture problem here with this niche industry that's going on? Because think about it. People own their cars longer than they ever have, right? This company would benefit from quick turnovers and short loans and short leases that get turned in. Most loans now, a lot of car loans now are like 72 months. They'll do them out far that, and a lot of people like that. So because that lowers the payment. Companies are starting to evolve. This whole thing is starting to evolve, and it feels like it's evolving away from these companies, Landon.
Yeah, I would agree with that. I agree that, I think people do like to hold their cars longer, and part of that has to do with the economy. I mean, when things are snapping and popping and you're making tons of money, everything's good, maybe upgrading your car every couple of years seems like a good idea. But when you're struggling a little bit, that's the last thing on your mind. It's getting you to point A to point B. It's getting you to work. You don't need to spend a lot of money to upgrade it. And so those longer cycles not only keep inventory out of CarMax's hands, but it keeps customers off of their lots. In addition, you look at a company like Tesla. Tesla, where your car, the day you buy it versus 2 years later, you could make an argument that it's better 2 years after you bought it because they're doing these over-the-air upgrades. So it's not just the car is depreciating, it's getting worse as you own it. In some cases, it's getting better as you own it. And so you're less likely to sell it, more likely to hold it longer. And I think the trend there is going to continue that way. Other companies are going to start doing things like that, where the software improves the function of the car overall. So, yeah, I would agree that long term, this is probably a tough spot, a tough business to be in. And, again, that's probably why I'm not an investor in this company. It's not really exciting to me. And they're also not the leader of the pack, which is, again, I tend to like companies that are in rising tides and they're the fastest ship, right? And this is kind of the opposite of both.
Yeah, you look at that price, nearly $156 a share in October of 2021. So it was doing really well when people coming out of the pandemic. But you mentioned the happiness levels. They're happy with the CarMax, but they're not, probably being as well liked by investors at this point than Carvana and maybe even AutoNation at this point. But at the same time, Landon, is this about the economy where, hey, this is going to be painful for a while just due to the fact that, hey, they get most of their, their business through their physical stores, right? Carvana is moving more towards, just online type of environment. Is that the key here, or is it just going to be scale where, hey, you need people to start re-upping their cars because this economy is pretty good and people aren't doing that right now?
Right. I think it's a little bit of both. I mean, efficiency-wise, having these giant lots with salespeople walking around all the time versus selling online, obviously one of those is way more efficient than the other. And so I think that's tough. But then I think it's also just a little bit of the macro where people are holding their cars longer. They don't need to turn them over. New car prices are more attractive than used car prices, given the quality of each. And so it's just a tough business to be in. I will say that, on some of the data that we've got, we're seeing people talking about getting their tax refunds and actually going and buying a used car. So there may be a little bit of a bump. I don't know how much that's priced into this earnings report, but there may be a little bit of a bump there, at least maybe on the guidance side. So just be aware of that. I don't think it's going to be huge, but they may talk about that because we did pick that up in the mentions on social media.
All right. Great stuff. Great data as always, Landon. Appreciate it.